Hi, I'm Dr. Jeff Camarda. As I wrote this in late March, the U.S. stock markets continued to float near record levels without a noticeable correction since the steep run-up from the election, though this seems to be changing in the wake of the healthcare standoff. This despite the recent Fed rate rise and its signaling that rates will continue to go up regularly through this year and through next year. While the U.S. economy still continues to improve and is finally generating more normal levels of inflation, the lofty stock rally keyed to an assumed explosive expansion based on expectations of Trumponomics may be a bit premature. In other words, the Trump rally has been widely explained by expectations of strong growth coming from tax cuts, massive infrastructure investments, the wall, roads, airports, and so forth, and the easing of business regulations to make it easier to make money and build wealth in this country. And while all of these things show much promise and may indeed come to pass, there are two flies in the stock market ointments. Number one, the president has no Harry Potter or Voldemort wand and must work patiently and in a spirit of compromise with Congress to effect real change, which will take some doing and take a while. And actual changes enabled by compromise legislation may be quite different than those spouted on the campaign stump, possibly blunting the impact. In yet other words, improvements may take longer and be markedly different than the market expects, and when the rally finally realizes this, or the market finally realizes this, it may shed some air, so buckle your seatbelts. By the way, this was much the Fed's recently revealed view, and its economic projections, while still quite positive, were much more subdued than those apparently expected by the White House and by the market. While things are clearly improving, the Fed, a band of pretty significant and powerful economic thinkers, still predict subpar, below 3% growth going forward at this point in time. For these reasons, Camarda still expects a fairly strong market correction, which should be used in our view as a buying opportunity for those with cash. Note we expect a correction and not a bear market, meaning we view the longer term trend as up. While things may take a while and be different than envisioned, Camarda believes the change in Washington should give the old U.S. bull market new legs and swift sneakers, and we are bullish out several years or longer. We just don't expect it to keep going straight up, and neither should you. We also note that the outlook for one of our favorite areas to invest besides the U.S., and that's outside the U.S., continues to improve, and as long-term viewers know of Camarda material, Camarda expects non-U.S. markets to outperform the U.S. in the years to come. For the record, Europe is now up more this year than the U.S. markets, and emerging markets like Russia have been incredibly strong, though down since in Russia's case down since the inauguration, so we don't think Mr. Trump's had anything to do with making Russia great again. That's all for now. Thanks for watching once again. I'm Dr. Jeff Camarda. See you next time.